Welcome to Lecture 2A for Public Administration 6123, our course on economic development. This lecture focuses on understanding the economy and will introduce you to some various economic measures. It kind of provides some further understanding of the topics that are covered in the Leviton article from Government Finance Review on the primer that he provided on being able to understand the economy. So let's go ahead and do the overview real quick. Again, we're going to take this opportunity to define those measures that you had a chance to look at. You probably saw this. But what I really want to spend more time on is just kind of familiarizing you with the sources and locations of those measures. All of this data is available online and is updated on a regular basis by the various agencies and organizations that update it. And then I'll talk a little bit about the ways in which we can evaluate it and show you some sources for evaluating, as well as kind of do some additional discussion to what you saw in the reader about the relationships between measures and their relationships perhaps with government and the economy as a whole. So let's talk first of all about the broad measures of the economy. This is really how, when you read about the economy in the news or when you see people talk about the economy, what they're really talking about is the overall value of activity going on. And there's a lot of different facets to it. But when we look at the total sum of the economy as measured by economists and by various agencies, what we're really talking about is the gross national product, or GNP. That's everything. That's payroll, exports, imports, trade, sales, everything together. The combined value, the total value of our economy is captured with GNP. And when I was growing up, this was the way that, for the most part, it was measured in the media. The media would talk about the gross national product. Well, then a funny thing happened that in the 90s, they started talking about what was known as GDP, or gross domestic product. And GDP, when we look at the economy today, this is what we really look at, because it's really truly the value of the U.S.-based economy. And what GDP is it's the gross national product minus imports. We don't count for imports because when you look at the GDP, you would say that the imports, while they are part of the economy, aren't a reflection of our productivity. They're more a reflection of what we consume. They are part of what we consume, but they're not necessarily a part of our productivity. So the GDP takes the imports out of the equation and only shows the value of either what is produced and consumed here and all the other aspects involving that, including payroll, and then also takes a look at what we export. The export value is included in GDP, but not the import value. Then, starting in the late 80s and really into the 90s, we were able to start tracking this economic measure, this total output measure, you could say, at the state level. And so we came up with a measure of gross state product. And this measure is provided for every state of all 50 states, as well as now for metropolitan areas. We actually have a metropolitan product that we can calculate. So for all the metropolitan areas of North Carolina, they actually can track what their gross product is. And then they do that on an annual basis. Gross national product, gross domestic product, and gross state product are tracked on a quarterly basis. In the primer, which was written back in the 90s, they were only tracking state product on an annual basis. But there are some groups out there that are able to do gross state product now on a quarterly basis. And that information is provided by the Bureau of Economic Analysis. So I'm going to now bring up the Bureau of Economic Analysis website, which you should see right there, and you can see that you've got a variety of reports. And the first thing you will notice is that when you look at this website, GDP, gross domestic product, is listed. They don't even list GNP anymore. They list gross domestic product. And this is being done here in late January, and we probably will have a quarterly release on GDP by the end of this week, or actually the first of next week. And that is, of course, it is updated quarterly. The first report or first estimate comes out typically at the end of the month after the end of the quarter. So for quarter 4, for Q4, which ends at the end of the calendar year, that release will be coming out. That first release will be coming out typically the last Friday of January, or perhaps the first Friday of February. And then a couple of weeks later, they'll come out with a revision, and then a couple of weeks after that, they will come out with another revision. So they give you kind of an initial estimate, then as they go through and firm up the numbers, and they provide more information. And as you can actually see, when you look at real GDP, the first estimate for real GDP for Q3 would have come out towards the end of October. And then they revised it again twice at the end of November and at the end of December. This release came out on December 22nd, and you can see that real GDP was reported to grow 3.5% in Q3 2016. And Q3 means annualized. That growth is an annualized growth rate. That's not that it grew 3.5% compared to last quarter. That it grew 3.5% compared to at the same time last year. So annual growth is what we track when we show those numbers, is annual growth. So in fact, let's just look at this release here, because I want to talk a little bit about what real GDP means. This is, of course, what what one of these press releases looks like, and you can see, real GDP percent change from preceding quarter, and these are annual rates. So we kind of started slow in 2016, actually a little less than 1%. Then we got up to about 1.5% in Q2, and then in the third quarter we did see substantial growth to where we had an annual growth compared to where we would have been 12 months earlier of about 3.5%, which is significant, because if you look back, you can tell that we did not have growth like that during 2015. We really haven't seen any growth like that since the third quarter of 2014. It's been below 3%, which when you look at economic data since 2006, 2007, what you will notice is we have not achieved overall annual growth above 3% all that much. We've been actually below 3%, and that concerns people, because prior to 2007, 2008, our annual growth from 1980 to 2008 was actually over 3%, just a little over 3%. So that's what people are used to with respect to growth. The other thing to think about is that when we talk about real GDP, we are talking about GDP that's been in these GDP amounts that have been adjusted for inflation. So technically, this would be GDP if we were using similar dollar values. We've taken inflation out of it. And that's important, because inflation can drive GDP growth, because you basically have just increased the monetary value of everything. That's not necessarily the type of growth we want. We want real growth that once you take inflation out of the equation, actually is growth. Now, right now, because overall we have not had significant inflation, at least the way statisticians look at it, since we haven't had it, it really hasn't put any pressures down on growth. Now, that may change as inflation picks up in 2017 and beyond. Going back to the website, you see that you have. Going back to the website, you'll see that you've got various pieces of information. I want to look at GDP. I want to show you a chart. There's a table here. Looking for it. Interactive tables. There we go. And I just want to show again. This is we're gonna bring up this chart. As you can see, there's a lot of different ways you can look at it. And what I'm going to pull up is I'm actually going to put up gross domestic product. I'm actually going to show real gross domestic product and in chained dollars. That means that they've taken the inflation out, and we're basically saying what the value would be based on a set amount. These dollars are chained to 2009. So in 2009 dollars, what is the economy worth today? And let's switch over to chart. And again, we have quarterly estimates. We'll use a bar chart because it's easier to see. I want to show all. And what you will notice here is this is going back to 2014. You'll see that the value has gone from $15.75 trillion. That's annual value that back in the second quarter of 2015, all the way up now at the third quarter of 2016 to 16.7. So about $1 trillion worth of economic growth within a 2 year, a little over 2 year period. In terms of annual economic activity, that is a lot. That's certainly an indication of growth. If you were to look at it from a line chart perspective, that's what it would look like there. This is the internal chart. I'm going to show you that something that works, in my opinion, a little better. Go back to national data. Sorry for these ups. I'm getting some email here. You have a whole variety. One thing I do want to show you is something called the implicit price deflator. This is kind of how this is kind of a measure of inflation. And actually, when you're doing research, like if you're working for a jurisdiction and you're doing research on like expense per capita or total expenses, one of the things that you need to learn to remember to do when you're like showing time series analysis is to make sure to adjust your numbers to reflect inflation. And one way of doing that is to use what's called implicit price deflator for GDP. This is actually recommended in the text by David Amons, who's at the University of North Carolina, in his work on municipal performance measurement, particularly including fiscal management. He specifically recommends using implicit price deflators. And there's actually one because inflation affects different elements differently. But there's actually one for government that you can use down here. And this measure again is kind of like a measure where 100 is the baseline, and so based on when this was in 2009, where 2009 would have equaled 100. At the end of 2014, inflation for government was at 111.7, and actually at state and local was a little higher at 112.9, really 113. So it was a factor of 13% over that 5-year period. Total 13% over that 5-year period. Going back now to looking at at the components of GDP, let's go back to real gross domestic product, just to show you some things. I'm going to reduce the size of this. You will see that there are a lot of different components of it. And let's just look at, as you can see, this chart, and you have these numbers. And again, these are annual numbers. This is not just what happens in a given quarter. This is the total annual value. The numbers have been annualized. You can see you've got personal consumption. And personal consumption has grown substantially as a share of GDP over time. It is a reflection of our economy overall, that we are a consumer-driven economy because of the large population we have and the relatively high quality of life. And in that you have goods, including durable goods and non-durable goods, and then you have services. And one other thing you will note is that while both goods and services have continued to grow, we have seen a higher rate of growth in services as compared to goods over time. Then you have private domestic investment. This is when businesses or individuals invest. This is the value of investment. You've got your fixed investment, which is capital investment. You've got your commercial side, your non-residential side, and it's broken down to structures, equipment. They added this item 12 here, I'd say about 2 or 3 years ago. Intellectual property products. They added that, and it's really an interesting. But that was added, and they went back and calculated it, and they did it to try to show that because of the changes in the economy, where we are more of a service side, technology side, and idea-driven economy, we really need to show the investment that's put into intellectual property, whether it's ideas about software or ideas about new drugs or new medical technologies, new procedures. Those things need to be calculated into the overall economy as an investment. Then you have the residential side in terms of the value of the residential housing market. And then you have changes in private inventory. And this is the idea of like how much is in warehouse, how much is in storage, how much are businesses holding of goods and services that are not necessarily being consumed. And that does change from time to time. And we show that change because it's a base number. So that change can either help. If inventories grow, it helps contribute to the economy. If it declines, it of course cuts into the economy. Then you have line 15 there, net exports of goods and services. And again, under GDP, if we were looking at gross national product, exports and imports would be added together. So the number for GNP would actually be larger. But because we're looking at GDP, we actually take the imports and deduct them from the exports. So what happens is that you have on the you have exports. Exports have grown. It's tapered off a little bit now because of the it's tapered off because of the dollar. The higher dollar hurts our impact with respect to exporting goods. It also makes it a little easier to import. So exports have stabilized and aren't really growing at the same rate they were. The growth continues to be driven a lot by services, but also by goods. Imports, we have seen some we have seen some growth there, and as you can see, we're out of balance. So in GDP terms, that reduces the overall economy because we have a trade balance of that we import more than we export. Then you have government, and government's consumption is a part of overall GDP, and it's also part of overall gross national product. And as you can see, it's about now at almost $3 billion if you include federal spending and state and local spending. Now, the one thing you will note when you look at this is that this does not include entitlement spending. So, for example, when you see federal spending is annualized at about $1.1 trillion, you're saying, well, the federal budget's way bigger than that, and it is. The reason why is that is your what you could say your program spending. You're spending on actual on programs that in a lot of cases is non-discretion, that is discretionary, most of it is discretionary, and it's related to activities that you would normally associate with government except for entitlements. When you take the entitlement number is tied back into personal consumption because entitlement spending is typically used to pay for goods and services. So the entitlements contribute to personal consumption, to the money available for personal consumption. State and local down here, and you can see that state and local is about $1.8 trillion a year of an overall $2.9 trillion contribution coming from government, the rest of it coming at the federal level. And then, of course, you see that they also separate out defense and non-defense spending as well. The residual is just kind of an adjustment factor, and as you can see, it's typically a negative, and it is. So that's kind of an explanation of GDP. The same information is available at the state level, so I want to go over here to regional data. You can and show kind of what we do. That you've got, as you see here, you've got quarterly gross domestic product by state, and then you have annual gross domestic product by state, and then gross domestic product by metropolitan area is done annually. So let's look at quarterly gross domestic product. Again, you can do it in real dollar, in real GDP. When it comes to looking at GDP by state, they look, and they do the same thing at a national level, but when we look at it by state, we look at it by industry. So what I am going to do is just go ahead and select all. So I'm just going to scroll all the way down. We're going to pick North Carolina because that's the state we're in. And I'm going to pick, I just want to show 2016 because we're showing it quarterly. There's a little bit of a lag in that they only have gotten now to quarter two, but you can see you've got the entire all industry total, which is about $446 billion. The total GDP of annual GDP of the state of North Carolina is just around $446.7 billion. And about $388 billion of that is in private industry. It's private activity. Then you look at government, and government's about $58.5 billion. You can see there are all different kinds of industries that contribute to it. You can see that perhaps the largest manufacturing is about $85 billion overall. Again, this is in chain dollars. If I was to go further back, you would see differences. That's the largest segment of our economy is manufacturing. Compare that to agriculture. Agriculture is pretty significant, but overall agriculture as a value of our economy is about 4.5, between 4.4 and 4.5. And agriculture varies because, of course, of the challenges of trying to grow crops. we definitely have a significant presence of livestock in terms of pigs and chickens and some others, but we also are predominant. We also do a lot of crop growing, and of course it's weather dependent. But overall, agriculture, as significant a role as it plays in our economy, is just a little more than 1% of the total economic productivity of the state of North Carolina. You can see retail and such. Then you've got property activities, about 51. It's kind of an internal thing. You look at the tech sector. The tech sector is worth almost $27 billion, but it's actually less than healthcare, even though that's been a significant area of growth for the economy. It's still it is one of the more significant ones, but then you look at still how it is significantly below where manufacturing is. And this is kind of the case all over. This area, professional, scientific, and technical services, has been where we have seen a lot of growth nationwide. Those states that have the ability to grow that the most are seeing the most growth. But when you look overall as its share of GDP, it's not as significant as perhaps you think. It's still your overall product is still tied to a lot of traditional elements of industry, including manufacturing and other factors. So that is something to think about in terms of, are those areas where we talk about the growth being the most significant, where you have 5%, 6%, 7% growth, and perhaps that it is growing, and that growth, because it's concentrated in certain locations, is enabling those areas to grow rapidly and see a lot of development compared to elsewhere. How does that reflect to the overall economy? Something to consider, particularly when we look at data at the state level. We're going to go ahead and go back to the slides. So let me run back to there and go to the next one. And again, we talked about, just to kind of to follow up, the Bureau of Economic Analysis manages these and updates them. They do their best to incorporate all industrial sectors, and as you can see at the state levels, and also when they look at it by industry, both nationally and at the state level and at the local level, at the municipal level, they look at it from a perspective of compensation, business revenue, inventories, taxes, liabilities, and capital charges. If you want more updated understandings of how calculations are done, take a look at the BEA website. They do have some FAQs and some other documentation there that kind of go really in depth into how these are calculated. We're now going to go now to inflation, which is measured predominantly by a measure we call the Consumer Price Index. Now, what the government does to track inflation is that it tracks inflation through a variety of tools, of indices. They have one for consumers, they have one for producers, they have actually one for construction. Then there are a couple of other outfits that actually do some that are even more defined. These are all measures of inflation, but do not take that to mean that they are a measure of cost of living. And the main reason is that there is really no easy way to measure cost of living, because each person is different. We can assume that people, if they were doing the same thing and had a comparable shopping cart or bucket of things they buy and services they use, that we could kind of look at it and go that over time we could figure out cost of living. But the reality is that we're all different. And the fact is we all respond to inflation differently, and it's not just overall, but it's also where the inflation occurs. And that kind of gets into a discussion about two different types of CPI of the Consumer Price Index. Now, at the time that Levitin wrote his article, the Consumer Price Index formula had not been changed for a long time. In the second term of the Clinton administration, the Bureau of Labor Statistics, which is the agency that oversees it, decided to incorporate some issues to try to respond to some issues that researchers have been bringing up for a significant amount of time. The two main things that they were concerned about was substitution and competition. And what they argued is, and again it ties back to the impact of inflation and the impact of inflation on people, is if prices that people are responsive to the economy, they don't just keep doing what they've done in the past just because, regardless of whether prices go up or down. They adapt and they change their lifestyles. And for example, the idea of substitution. And it was based on the idea of, okay, we track the prices for different types of beef. Well, the shopping cart that's used for CPI may incorporate the idea that you're going to buy steak every week, that you buy steak once a week. And the right comment says, well, we know that's not what actually happens. If the price for steak gets too high, you're going to end up buying hamburger. Now, this was back for those of us who eat beef. Some of you may not. I apologize if that's the case. If you find this not to be the best example, but the reality is that's easy for me to explain because typically steak costs more than ground beef. And so what's going to happen is that while the cost may be going up, people's actual activities may not necessarily be as impacted by inflation. Then you have competition. The idea being that there was greater competition, particularly from warehouse stores like Walmart and Target, that were going to impact the cost as well because it would help, it would adjust actually what people were paying. What they were trying to say was that perhaps some of the measures of inflation were a little overstated. A lot of this resulted in kind of a softening of the rate of inflation over time. Now, you have some other people who will argue, and a lot of these are kind of people who are on the fringes of economic analysis who will argue, no, we should have kept it the same way because then that would show what true inflation is with respect to maintaining your quality of life. We don't want, if we want to grow as a nation, we shouldn't be having to force people to substitute or change. There are also, of course, considerations made about the adoptions of technologies and of different types of ways of consumption. So there's been a lot more adjustment in how this, in terms of the type of data that's collected and how the data is collected to determine CPI. And there's been more active changes to that. To some people, that means that that it's not as reliable. My feeling is that the best way to look at the CPI is to look at the overall numbers and then to look at it by industry or look at it by product group or service group. Because the fact is, if you are someone who is paying for your health insurance, if you are paying a significant amount, or you are susceptible to annual increases in your premiums, or that you don't, or that you're someone who perhaps does not have insurance or has a high deductible plan, chances are that's where you need to look at, because that factor could significantly increase. Like if you say had a $10,000 deductible, and in the past you've spent about $1,500 a year on your personal health insurance, and prices go up 10%, that's going to affect you by about $150 a year. If you're only making, say, $30,000, that's noticeable. It's 0.5%, but it's still noticeable because that's money that you may not have to spend somewhere else. So it's kind of, again, that's the reason why we talk about that CPI is about inflation, not cost of living. Some of the things that have been done in recent years have led it to kind of tie to cost of living, but in reality, what it's supposed to be is it's supposed to be a measure of inflation. There are, of course, different ways of calculating it. The CPI-U is the broad one. It is for all urban workers. And this is based on the idea that there are slight modifications, of course. This is to kind of account for that we have a general index that's for everybody, that's supposed to balance out for everyone. Then we have what's called CPI-W, which is for wage workers, those who earn hourly wages. And for the wage workers, their costs can be different because of the way that they consume certain services or because of some other factors that affect their life. Now, these are some broad assumptions and some broad generalizations that are scientific and perhaps backed by evidence, but obviously that they kind of point to some disconnect that exists between those who are perhaps salary or professional workers and those who are wage and are more trade-oriented or in more pre-professional or administrative support roles. The main thing to look at that we talk about with inflation is there's two primary measures of inflation. One is overall consumer price index, and the other one is what they call core CPI. What core CPI does is that it takes out the cost of food and energy. And the reason why it does that, according to the research, is that core CPI, they want to remove the volatility associated with the food and energy, because both of them can be volatile with respect to supply and demand. We know very well how energy can be. There was a time where food was. Not as much now, but both of those do have higher degrees of volatility in their measures, where prices can go up at higher rates in shorter periods of time and go down at faster rates in shorter periods of time. Most everything else is supposed to be gradual, supposed to be linear, and not have as much volatility. And so when they talk about core CPI, they're looking at the less volatile elements. Now, if you're somebody who commutes 100 hours a day to work, that means that core CPI may not be as valuable to you because you're using a lot of gasoline. Also, these are index models where they take a point in time, call it 100, and adjust from there. So that allows you to have kind of an ongoing comparison from month to month, year to year, as well as from a starting point. And that's kind of how they work. So let's take a look at CPI, a Consumer Price Index. Again, it is measured by the U.S. Bureau of Labor Statistics. It is reported monthly, typically in the middle of the month. They also, of course, do unemployment data, which is not part of this discussion today. But or they also do unemployment data. It may be. No, I don't know if it is or not, but we'll find out. CPI, Consumer Price Index. We pull it up here. As you can see, this is calculated on a monthly basis, and when they did it back in December, so the information actually came out actually last week. It's typically the middle of the month. It was unchanged. It was unchanged for the most part. That's the non-seasonal average. Typically with these, they do what's called a seasonal average and a non-seasonal average, which really reflects month to month. The seasonal average provides some leveling so that you can look at things from a kind of over time and take some of the volatility out. Seasonal average had gone up 0.3% in December. Now that is a difference between where it was in December and where it was in November. So that is a case of a month-to-month change. If you wanted to look at the data, then you look at they show again, this is the core CPI and this is CPIU. You can see it again unchanged for the non-seasonal. Seasonal was actually +2. And that then you look down below that third line, non-seasonal average plus 0.2 plus 1 since December 2015. So that's the 1 year difference. Then they actually now show things like medical care. They take the medical care and they show that separately. And that gives you an idea of a particular sector. And as you can see, the non-seasonal average went up 4% in the last 12 months from December 15 to December of 16. And as you can see, that's a higher rate than the overall consumer price index when it's balanced out, as well as, and you can tell that there wasn't as big of a difference between core and everything. Then you go down to wages, and you can see that whereas there was a little bit of a bump in the non-seasonal average, when you look at the non-seasonal average for the 12 months, it's actually 1/10 lower than it is for all workers. So what we see right now going on, at least according to statistics, is that there's not that big of a difference for seasonal and between wage workers and salaried and hourly and wage workers, and that overall that medical costs are rising at a rate higher than the overall rate of inflation. So they are contributing to increase overall inflation, not decrease it. So that there's a lot of information to pull from there. The data that you can look at is down here. When you get to this page, you come down to databases, and there's all the information that you would want with respect to consumer price indexes. Also, the other thing is that CPIs are calculated on a regional level, so you know that it's done regionally as well as in some metropolitan areas. But like there is a South regional CPI, consumer price index, which I'm going to bring up real quick. If it loads, and you'll see this is for all urban customers. They also have them for select industry groups, and you can see that this is for all of 2016. It actually goes from 2006 to 2016, and it kind of gives you an idea of where it's gone over that time. In terms of these measures. And in this particular index, the measure mark for 100 was set back in the period of 1982 to 1984. So if you went forward from 1984, that's kind of the baseline. So what that would indicate is that since 1984, the overall cost, the overall inflation overall has gone up about 130% in the South urban areas. That would indicate that what that would mean is that, like, for example, if generally, you know, price for a certain group of items that was part of this survey was an average overall $500, that now it is, let's say, 135, that it is probably about about 1150 is what it ends up being. So what was $500 group was $500 in 1984 is now $1,150. That is a significant increase, but the important thing to realize is that between the 1970s and the 1990s and the 2000s, that in the 1970s, inflation was just out of control. It was in double digits for a long time, from the late 60s into the 70s, and it really didn't subside until the 80s. But that was probably some built-up inflation, because there wasn't a lot of inflation in the 50s and 60s or in the post-war period. Inflation really kicked off after that, and some of the things we've done with globalization have helped control inflation as well. So let's now go back to the presentation and look at our next topic. The next measure we're going to take a look at are the trend indices. These are measures that have been developed that allow us to take a look at economic activity, allow us to kind of look at how things have been going, where things are now, and where things could be going. In other words, lagging, coincident, and leading. Kind of like past, present, future is a good way of looking at it. Lagging indicators deal with, the past 6 months, past 3 months. Coincidence deal with the current time frame, month before month coming, and then you're looking at kind of a 3 to 6 month forward view. The writing talks about that these are developed by the Census Bureau. They're actually not. They're developed by a private organization called the Conference Board. They survey CEOs in the United States. They also do this globally, so you can actually go to their website, which we're going to look at in just a second, and you can actually see that they do these kind of indicator reports for major industrialized economies across the world. It's actually a very interesting report that they do. So I want to take a quick look at that. Let's pull up that page and go to the Conference Board. We'll go back. I do want to show some stuff from the Census Bureau. This is the most recent report. I'm just going to do something real quick and update it and see if it's been updated. It has not. So this is December, the last time a report was released, and this is the Conference Board website. They control a lot of the data, but there is a press release that they run that provides the basics that you want to look at in this regard. Okay, interesting. This is the press release, the most recent one. I'm going to zoom in on it. And you can see this is the most latest one, and what it shows is that the Conference Board has the main thing people look at is the leading indicator index. That's where they want to see, because when people look at this, a lot of times when they look at economic indicators, what they're really looking at is, where are we going? Where are we going? How are we looking for the future? And so the Conference Board's LEI, that's the leading economic indicator index, was unchanged in the month of November. It's recorded monthly, and it does and it's adjusted from month to month. What it is at now is at 124.6. In 2010, when they benchmark it, they typically change the benchmark to a given period of time and kind of say, they do that to kind of give you an idea of, most people can remember where we were in 2010, which was kind of we were still coming out of recovery, and it was kind of the end of the last recession period. The last recession period ended in late 2009, the last recession ended in 2010, according to the way economists view it from the standpoint of economic activity. For some people, it still hasn't ended, but the reality was, you can see that there were small increases in that leading economic index in October and in September. The December numbers are not out yet, but it continues. The key thing with this indice is that it's a trend-based measure. So you don't look at one given month. You look at how 1 month's measure or statistic compares to prior months, and particularly with leading indicator, you kind of see, because if you see that it continues to grow over time, that's an indication that indicator of positive of optimism, because if it was above 100, it would be optimistic. If it was below 100, it would be non-optimistic. you begin to realize, okay, this is where this is a good sign. This is a sign that there is a certain degree of assurity in economic growth that we can look forward to. And so you also see the same with the coincident economic index, which is in the present, and again, it is growing, increasing. It actually increased a little bit in November and is increased in past months. And you can see the coincident indicator is a little lower. And that's not uncommon, because typically we are more optimistic about the future than we may necessarily experience in the present. But both are moving in positive directions. Then you look at the lag, and the lag is at 0.3 in November. It went up 0.3% in November, and what that tells you is that there's kind of what that indicates, because that measure is very similar to the LEI. There's not direct correlation, there's not really a direct relationship, but the fact that they are all moving in the same direction and that their values of the leading and the lag are similar is a good sign with respect to the overall position of the economy. So this is the kind of measure that you would look at. In terms of what they use to calculate it, they take information from other indicators in the United States for the LEI, for the Leading Economic Index. These are the ones that they use. There are 10 components to it. And I'll just pull that up right there, and you'll see they look at weekly hours average for manufacturing. This is part of employment reports. You'll be learning more about this with labor market analysis. Weekly claims for unemployment insurance. Obviously, that's a measure that if hours go up, it's good. If claims for unemployment insurance go down, that's good. New orders, again, that's a manufacturer's new orders. That comes from the Census Bureau. That is a good measure. The ISM index on new orders, that is from the Institute for Supply Management. It's another nonprofit that does a lot of surveying of member businesses. Manufacturers' new orders, non-defense capital goods, excluding aircraft. And the reason you don't include aircraft is that aircraft orders are kind of volatile. Boeing just doesn't get 20 orders a month. They get orders at a given time of year. Their orders are kind of as bids come out. So there's no like season for buying aircraft like there's a season for buying cars or a season for buying other kinds of equipment. Building permits for new private housing is one, and that does combine. I do believe that combines multifamily and single family. Then you have stock prices, 500 common stocks. Don't know which ones those are. Leading credit index, looking at the overall financial markets and the banking markets, I guess is better to put it. The interest rate spread. Again, this is dealing with 10-year treasuries. Looking at kind of how those rates spread, and I think there's factors with respect to that measure. And then average consumer expectations for business conditions, and I think this ties into consumer confidence, which is, if I remember correctly, is going back to Bureau of Labor Statistics. I'm trying to remember who calculates consumer confidence. Consumer confidence. These are examples of some of the looking at consumer confidence. And then consumer expectations for business conditions. That's tied a little bit into the consumer confidence report, which is also done by the Conference Board. The Conference Board also does reports on consumer confidence. So this is what they do. This is how they do the report. And again, this information is great to have and great to use. There's obviously a lot more detail that they do in their own analysis, and a lot of that's proprietary that they provide to their business members. Now, obviously, when you start really delving into economic data, you will find that the leading economic indicator index that's developed by the Conference Board, as well as their Consumer Confidence Index report, are not the only indices that are available. There are a lot of other indices that have been developed by various groups to try to provide perhaps more specialized information, more localized information. This is especially true when you're doing local and regional economic development, and because we know what the methodologies are, there are even some people who try to develop their own methodology, their own models, based in part off of the established methodologies for the more commonly known primary indices. going back to what we have available online, want to look at these are one of my favorite sites to pull data, to pull reports from is from Wells Fargo. Wells Fargo, the bank, also is got a very nice economics analysis shop that was actually part of Wachovia. It's based in Charlotte. So it's got a strong North Carolina connection to it. And pretty much when any major economic measure or economic index comes out, they do a nice little brief summary about it. And let's pull one up that's been recently. Let's see here. Let's look at consumer credit. That's always an interesting one. This is kind of like one of their reports on consumer credit. And what they do is they take the report that comes from the agency that prepares it. The consumer credit information is provided by the Federal Reserve. It's done out of their New York office. And they kind of provide some charts and they do some quick bullet points. And it kind of just gives you a good little overview about what's going on. This is for November, and what they show is that consumer credit activity actually increased. It had been going down in September and October. People were borrowing less, or people had less. Credit was going down. The amount of credit available to consumers was declining, and then it jumped up, and it jumped up especially in revolving credit. Now, if you're a Dave Ramsey disciple, you would probably say this is a bad thing. And I can understand that. This is not a judgment on personal finance behaviors and practices. But the reality is that because we are a consumer-driven society, having credit available, including the revolving credit, i.e. credit cards, available to people is important, because that means people are going to be in a position to buy. And if you are a business, particularly if you're a corporation that has manufacturing operations and distribution operations, you're not as terribly concerned if people are buying with cash or with credit. You just want them to have the liquidity available to buy. So, for example, if you are in the business of selling washing machines, there are not a lot of people who buy washing machines on cash. They buy it with credit. Normally, they buy it with a credit card. Some places you can go and get it financed, and honestly, when you finance that type of stuff, you're actually financing for a credit card at a much higher rate because they'll let you keep it. But the reality in this case is that most people, what this shows is that people were going out, they were getting their credit limits increased so they could go out and make some significant purchases during the holidays, or that they could buy more for the holidays. I had to buy, my wife's old iPad died or was dying towards the end of the holiday season. Actually before the holiday season. So on Black Friday, I went and bought her a new one. Now I paid that with my debit card, but the fact is that if I needed to, I probably would have gone and said, "Hey, can I get an increased limit on my credit card?" I didn't do that, but a lot of people did. We also talk about non-revolving debt, which that includes, the main factor with that are student loans. Student loans are a pretty significant issue now in the overall credit market because there's a lot of it out there. Some of you probably have student loans, but that's something else that they track. And as you can see, overall, when we look at consumer credit, about 74% of total consumer credit is non-revolving. And of course, the main culprit with that is your home mortgages, but also auto loans, signature loans, as well as student loans. So those are some of the examples to think of. But overall, credit grew by about 6% for the year as of November. And so that meant a 6% increase in liquidity. At the same time, if I believe I'm correct, wages had grown. So the reality is that, as people's wages grow, their access to credit can grow. And with interest rates growing up, that's actually going to increase accessibility to credit because more banks will be interested in giving credit to individuals. It's about the risk and the affordability of risk. And of course, that's one of the reasons why revolving credit has a higher interest rate, because there's more risk to the bank in terms of getting it paid back. Because when you're dealing with that, you're not able to secure the debt on the products being purchased. It's like basically having a signature loan for a large amount of money based on your income. it carries more risk and higher higher interest rates. Now, I also mentioned there was another one that I wanted to show you, and that is the NFIB, National Federation for Independent Business, does its own economic index, and it's what they call the optimism index. And small business optimism, they go to their members and they actually look at their optimism, and small business optimism is a leading indicator. It's based on expectations, and they look at it in a whole host of different categories. I'm showing it here because there's actually a website that you could go if you Googled NFIB small business optimism, it would take you to an NFIB website where they have more detail. But you can see this little area here that you may see shaded. That's the 2008, 2009, 2010 recession, and you can see how optimism dropped. And while it has perked back up to some extent, you can see that it barely got to the 100 pointer, kind of like that, base point going back to 1986. It barely got up there until sometime in, I think, late 14, early 15. I think that was when after the midterm congressional elections. But since then, it's dropped back down. And what you see, and you can kind of see that the average since 1988 is actually below 100. It's at 98. But what you can tell is the election results in November were phenomenal with respect to optimism. And when I read their reports, they will tell you that the biggest concerns that small businesses have, a lot has to do with the impact of entitlements on their bottom line. Regulation is another concern, but entitlements, because it affects their ability to employ people. In particular, when you look at the Affordable Care Act, it creates a lot of challenges for business. This is not talking about the benefit of health care. This is talking about the impact of the law as it is written on business. And going back to the discussion we had in a previous lecture, this is one example of how public policy does, whether or not it's intended to be economic policy, becomes economic policy, and this is a prime example of it here. Now, one other example I want to show you, Dr. Michael Walden, who is, of course, I would say the people's economist of North Carolina. He is at North Carolina State University, taking nothing away from the great economists that work at East Carolina, but Dr. Walden, for many years now, actually just before the recession and since then, has developed a statewide index of leading economic indicators. And this one, he uses pieces of the conference board. He includes the overall, he includes jobless claims, he includes, there's actually a report that he uses called the Weekly Leading Index, which is actually developed by another group called the Economic Cycle Research Institute, jobless claims, building permits, hours worked, and earnings. And he ties those together, and he uses them to kind of develop his index. And in fact, his index for November saw a pretty substantial spike. It actually went up 2.8%. You can kind of tell that his index has actually been below 100 for a while. I'm trying to remember exactly what his start point is, but the key thing to see is that it's been below 100 pretty much since it started, and back in 2009 when it reached its lowest point, it was below 80. So it has grown, and it has kind of been stabilized and grown again, and it was kind of stabilizing but started picking up growth. It actually grew for the year pretty well, and then had a nice drop pickup in November, and it'll be interesting to see what the November numbers look like. So these are some examples of other types of indices that are out there, and I can tell you right now, you can certainly find even more of them if you look on your own. So let's wrap up with some questions for us to review, for you to review as we finish up this lecture. When looking at these measures that we've talked about, and obviously there are a lot more, we'll be talking about measures with respect to employment. Those are going to be main ones. We're going to be looking at demographics. I think a lot of people say employment to them is their most important, and I'll talk about how you really have to look at employment a little more closely than just the basic numbers. But what of these measures that we've talked about today mean the most to you? And to you, what matters the most? There's a lot of others we could have looked at, but I could have done 2 or 3 lectures on this subject. And ask yourself, how critical
or how important is it for us to track these measures that are available at global levels, or maybe even at state levels, or maybe in some cases metropolitan levels, but for the most part are usually national and global levels? How important is it for us as local governments to track this? I believe it's important because we need to know kind of what's going on in the broader economy. As we referred to in the first lecture, Friedman made it very clear that we are more interconnected, so the chances of having perhaps that insulation from global economic activity is not as great as some localities had it. And looking at some of those alternatives that we talked about, and perhaps some other alternatives you can find, I would certainly encourage you to use your Google to look up the Richmond Fed, the Richmond Federal Reserve. They have a lot of economic measures, and there's some relating to industrial, to manufacturing and non-manufacturing activity, and I think that would be interesting to look at. Ask yourself, which of these do you think might be best applicable to incorporate into your analysis when you're looking at the county that you've chosen for your work throughout the course of this semester. So that is all with respect to Lecture 2A.